Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that's been trending down over the past couple of weeks here. We're really seeing here a lower high on the market. We've had a lower low on the market, so a lot of concern regarding this beginning of a downtrend here. A lot of people talking about 2008 or the dot-com crash, as we are seeing a lot of recessionary signals, right? We've had the yield curve that's inverted. We've had spiking oil prices throughout the past few months. And meanwhile, the Federal Reserve is beginning what looks like to be a very, very hawkish and aggressive hiking cycle here. So it's difficult to see how someone could have a positive outlook on the market right now. Being bullish on the market is definitely a contrarian outlook. Very, very few investors are expecting a rally back up to the all-time high, and much less significantly exceeding the all-time high. So we're going to talk about all that. We're going to talk about sentiment, what to expect in the next few weeks, whether here today, as I'm making this video, we're seeing an early sign of a reversal that will lead us back up to the all-time high. If you're interested in following these crazy markets with us, make sure to click on that subscribe button. And now, without further ado, let's get right into it. All right, so I want to begin by just making a quick overview on what has been driving this correction. We've talked about this many times, so I'm not going to talk about this too much, but this correction here, this entire correction has been driven by the Fed tightening narrative. People have been pricing in this aggressive hiking cycle, right? We just talked about the Fed funds rate. This is the rate at which they lend to other banks. And so it has an incredible impact on the economy and hence on the markets, on liquidity. And so when they tell investors that they're going to be hiking up to 2% within the next year, that spooks the market and it creates sell-off. The market begins to discount that hiking cycle. And we've seen that many, many times in the market. Right before a hiking cycle, or right as it begins, you have that volatility as the market is discounting that hiking cycle, right? It happened again here, beginning of the hiking cycle, the market is discounting volatility here. Beginning of the hiking cycle, the market is discounting. Lots of volatility in 2015, 2016. So here, this is not at all a surprise that we've had this correction. And I don't like to go back too much on the calls we've made or we haven't made. But if you were with us a few months ago here, back in late 2021 or early 2022, we were talking about this exact concept that at the beginning of the hiking cycle, right, this was January 3rd, 2022, before any type of crash in the market, we said that when the Fed starts to get hawkish, you get volatility in the market. That's how the markets work, because that hiking cycle starts to get discounted by the market. And so that is precisely what we've had throughout the first part of 2022. Now, I want to head to another site here, cmegroup.com, and it shows us the target rate probabilities according to market participants. And it shows us the probability of the target rate being at a certain level according to market participants at the May meeting, at the June meeting, at the July meeting. So let's take a look at that and see what the probabilities are for each of these meetings, right? I'm going to skip straight to July of 2022. But before I do that, let's quickly look at what's priced in for May right now. It's a 90% probability that we get a target rate of around 75 to 100, right? We're currently at 25 here. We're currently at 25. That means that the market has priced in, it has discounted 90% probability that we're going to be at 75 basis point. So in other words, the market is absolutely not going to be surprised by a 50 basis point hike in May, just like it was not surprised in March, right? I remember everyone was talking about a crash here in late February, early March, because the Fed was about to hike 25 basis points. And when they did, that very same day, the markets rallied massively, super impulsively. It surprised everyone. It took everyone off guard, especially on Twitter and YouTube, where sentiment was very bearish at the bottom. That's how the markets work. They discount before things happen, and when they happen, they look forward to better news. So let's fast forward to July and see what's currently priced in. We have 50% probability that we're between 175 and 200 basis points, and 25% probability that we're between 200 and 225 basis points. Now, what does that exactly mean? It means that the market is pricing in 75% chance that the Fed is going to hike 6 to 8 times between May, June, July meetings. The market is pricing in 75% chance that we get 6 to 8 rate hikes. That has been priced into the market. So you can understand this reading here that we have on the AAII Bull survey we had last week, this historical reading of 15% of investors that are bullish on the market. Nobody's bullish. We're barely 5% off the all-time high, and everyone is calling for the markets to go down. They say buy when others are fearful. That's about as fearful as it gets. This was COVID right here. This was COVID. This is where we are now. I'm not saying that we're going to get 2 to 3 year bull run here. I'm saying that we're massively overextended to the downside and that we have a lot of room for improvement and not much room for the market to get spooked, at least by tightening, right? 6 to 8 rate hikes. That means if they only do 5 rate hikes, right, which is still a lot by historical standards, if they do 5 rate hikes, that will be perceived as dovish, very dovish. And so that's going to trigger rallies. It's going to trigger an improvement in the market sentiment and in inflows on the S&P 500. And that's right as Jamie Dimon, the CEO of JP Morgan, sees storm clouds ahead for the US economy later this year. Jamie Dimon is now getting concerned about the Federal Reserve. Now, I'm just saying this is a fun part of the video, but he's probably buying here. Don't get misguided by these types of headlines. I remember very well back in late 2021, Jamie Dimon was extremely optimistic about the economy. So he's waiting for retail investors to capitulate on the Fed tightening narrative to get back into bullish momentum. Of course, that's why you come to these videos, to get a higher level perspective on the market. If you enjoy these videos, if you enjoy the research, the effort into putting out these videos, make sure to click on that like button. Now, the next core part of what we're currently looking at is this chart right here. This is the Nasdaq 100 divided by the S&P 500. And you can see the trend we've had on this chart here, massively down throughout the past few months. This has been weighing on the market. It has been bringing down the market. And if we take a look at the root cause of that, let's put up the 10-year yield on top of this chart. We know that tech is greatly influenced by the 10-year yield. And when it's rising, when the 10-year is rising, that puts pressure on the growth sector. You can see that inverse relationship here. Big rise in the 10-year, big fall in the Nasdaq 100's performance. When the 10-year starts to go down, as it did throughout the summer here in May, June, July 2021, that's when you can see strong recovery in the technology sector. So until bonds start to cool down, you're going to continue to see a lot of volatility in tech, and that's a headwind to the S&P 500. That makes it more difficult for the S&P 500 to rally. Let me just quickly show you that. This entire period of volatility here, this is precisely that moment where you had the Nasdaq divided by the S&P 500 underperform. Let me just show you that right here. This entire period of volatility, that's when you had tech sell off. So a large part of this volatility is tech selling off. And why is tech selling off? Because yields are going through the roof. And that brings me to one of our recent articles here on the bond market, where we highlighted this chart here of the 10-year yield and the extreme overextension you have between its moving average and the actual yield. And you can see that, and I'm going to just show you on this chart here a little bit more clearly. This indicator here at the bottom shows you the percentage difference between the price and the 50-week moving average that you have here in blue. So when price is a lot below that blue line, you have a big move down on this indicator. And when it's much higher than that blue line, you have a big move up on the indicator. And you can see here, relative to the moving averages, we're extremely overextended compared to the moving average, right? Extremely overextended. And so we've only had 3 readings in the past 20 years that are similar to this. It occurred once in 2013, once in 2016, once in 2021, and once now. And that gives you an idea of the risk reward you have on the 10-year yield. It's very, very overextended. And that's as we're testing this major line of resistance. I don't like to make short-term calls on the market. I try to avoid that as much as possible. But if I were to guess what's going to happen this week, I think we're going to see selling pressure bring the 10-year yield back under that line, back under 2.8, and it's going to start to roll over because you rarely get big important breakouts when you have such high overextension. That just doesn't happen. I would start to consider the potential to see a longer term breakout if we have a consolidation and then we recoil to higher highs, although I don't think that's going to be happening. That's the worst case scenario for the bond market. So that makes the technology sector increasingly attractive. As soon as yields begin to cool down, you're going to see the Nasdaq 100, you're going to see the ARK ETF, for example, outperform significantly. And considering these indices are very oversold, we've added them to our trading watch list on gameoftrades.net. And that means that we're following these trades every step of the way, seeing if we need to reevaluate our thesis, what are the key developments and the key levels that we're watching. And we give that out for you guys in comprehensive articles that take into account the macro, the intermarket analysis, the different ratios that we think are fundamental to understanding the market, and the technical analysis that gives you that visual component to understand the research. And of course, we give you guys a nice conclusion with a nice summary at the end. We've had a huge amount of great feedback on our articles. It's always great to see that. If you don't have an account yet and you are interested in having access to this, make sure to check out the link in the description below. We've had a tremendous amount of interest lately, and it has been difficult to keep up with the customer service. I do apologize for any delays when it comes to answering questions by mail. We're trying to expand the team, but we may eventually have to begin restricting access to the membership while we're able to get that part of the business covered. So this is the Nasdaq 100, and it's been trending down violently here, and that's not a surprise. We've had the 10-year yield that's massively spiking, and it's waiting for that to start rolling over before we see a big rally on the technology sector. So short term, again, it's always difficult. We could see more volatility, but what I'm seeing here from a technical standpoint is a potential head and shoulder pattern. If that plays out, you've got potentially a massive rally ahead of us that I don't think many people are expecting here. Let's put that measured target up. That could take us to 17,300 points, which from current levels, that's a 24% rally. These are massive, massive gains. Now, I hope you guys enjoyed this video. If you did, make sure to click on that like button. Subscribe to the channel if you haven't already. Make sure to check out our website at gameoftrades.net if you're interested in our research, our trade ideas, our watch list, everything that we're currently looking at in the market. Now, in the meantime, I wish you good luck on your trading and see you next time.